Good day, everyone. From sunny Winnipeg, from 201 Portage Avenue, I'm Rob Tatro from robtatro.com, portfolio manager from Canaccord Genuity Wealth Management here at the Tatro Wealth Advisory Group. I'm excited today because for the first time, we're going to be having an actual technical and quantitative expert to talk to us about specific stock patterns, what he's watching for, what his technical outlook is for 2020 in the stock market. I'm really thrilled. It's going to be neat. I've kind of reviewed some of the material that he's doing. Today, guys, we're going to be talking about patterns. We're going to be talking about, relative strength index. We're going to be talking about momentum in stock prices, signals, charts, trends. We're looking at stock charts today, and we're going to be taking a deep look at them. I will bring our guest in right now. Folks, live from, not New York, from Toronto. I'm excited and thrilled to be bringing in one of my partners, someone that I've been working with hand in hand for a while here. Javed Mirza, quantitative technical analyst. He's our research specialist from Canaccord Genuity Corp. Javed, welcome, and thank you for being here.
Thanks so much for having me on the show, Rob.
Yes, thrilled to have you. Okay, I'm going to share my screen here, Javed. I'm going to take you through some of the slides that you've prepped for us for this call today. This is the NASDAQ Infotech. What are you watching here? This is NASDAQ Information Technologies with respect to price, RSI, and long-term trends.
Yeah, so our view here is that information technology is leadership. It's funny. I mean, look at the names that you just mentioned. Square, Shopify, those are all information technology names. Microsoft, Facebook, Google. Well, I guess Facebook and Google are more on the communication services side. But Exactly. But the bottom line and the key takeaway is that information technology here is leadership. And then so what we do is we highlight again on RSI there is that key 50 level. And what you can see is in the tech bubble from 2000 to 2002, and then most recently during the financial crisis from 2007 to 2009, RSI moved below that 50 level. But notice that we remain well above it here. So if we do move below that 50 level, which would happen if the index continues to deteriorate in price, then of course that would suggest two things. A, that we're moving into a secular bear market, which, if you go back look at the previous slide, the reason that's important is, we've had a pretty big move lower. But if we are in a secular bear market, then ultimately we could go around, test the 1700 level on the S&P 500. So that still means we have some room to go to the downside, which is why we're watching all these things so closely. But if we do go below the 50 level on the NASDAQ, that to us would strongly suggest that there's a change of leadership in line with a shift into a secular bear market in equities. And we'll talk about that a little bit down the road as well.
Yeah, like the dipping below 50 is going to happen, in my mind, on the S&P way before it's going to happen on the NASDAQ, correct?
Exactly. Yes. Yeah.
And that's because of the leadership right now. Although if that switches, that would be a strong bearish indicator for the technical stocks, the tech stocks.
Exactly. Yep. Exactly.
Now, you got some neat blue and red lines here. Yeah. I know what these are, but do you mind kind of sharing what your thought, how you draw these support? And where do you pick these points to draw these lines in this? Like you have a line here at 27.81, you have a line at 45.73, and you have a line at 64.96.
So the blue lines and the way I do all my work is red lines are typically negative or resistance, and blue lines are support. So support, for anyone who's interested in reading up in this, there's a lot of introductory technical books. I think the one from John Murphy, anything from John Murphy is great. But the key takeaway is that technical analysis, for people who don't understand it, is it incorporates a lot of fundamental analysis. And what I mean by that is these inflection points that we're seeing on charts are levels where the index is either overvalued, which means it becomes a resistance level, or it's undervalued, which means it becomes support. So when it's undervalued, it means all the fundamental portfolio managers from their models are showing that the stocks are undervalued, and this is a great opportunity to buy. And what we as technical technicians is we see this happening on the charts because these are areas where typically once you come back to those levels, stocks hold in pretty firm and they rally. And conversely, once they come up to a level of resistance, it's telling you that portfolio managers are seeing the stocks fundamentally extremely overvalued. And so that's typically where they sell.
Yeah, like I've seen you draw a ton of these in my dealings with you, and typically the support will be kind of at spots where the market dropped to that point, came back, dropped to that point, came back, dropped to that point, came back.
Yep.
Sometimes it's an emotional number, right? Like sometimes it's just, it'll be a round number like 4,500 or 6,500 where people or algorithms will choose to sell or buy at that level. Therefore, it's a resistance and or support. But sometimes it's just basically based on charts, right?
Yeah, and like I said, the charts are derived from the models that actual fundamental portfolio managers are using.
Yeah, really, really neat stuff. Let's go to the next one here. This is your line in the sand chart. I really like this one. This is for the S&P 500. So the S&P 500, for our guests out there that don't know, this is the large cap index, the American. And I know you do some charting for Canadian stocks. You do quite a bit, but this presentation was largely focused on American. So take me through this chart and why it matters. I mean, you talked about closing above the 4-year average. Why is that important?
Yeah, so let me back up and tell you, I mean, our focus is on the S&P 500 and North American indices. And I'm sure you've had heard the saying when when the U.S. sneezes, Canada catches a cold. So
COVID.
So whatever's happening in the U.S. is going to have a big impact on Canada because it's our largest trading partner. So if the U.S. economy is running smoothly, that should be great for Canada. And conversely, if the U.S. economy is under pressure, then there's not as many consumers for Canadian services and products. So that red line that you can see there, the thin red line in the second or in the main panel, that's the 4-year or 200-week moving average. I'm sure most of the people listening to the show have probably heard of the 50 or 200-day moving average.
No, so let's pause. Let's pause there, Javed.
Yeah.
People might not have heard it. So a moving day average is effectively you take the prior 50 days if it's a 50-day moving average, or you take the prior 200 days if it's a 200-day average. In this case, it's a 200-week average, which is a 4-year average. So you take the prior 200 and you average it out. It smooths it out dramatically, which is why this red line looks so straight, is because you're averaging out 50 trading sessions or 200 trading sessions, or in this case, 200 weeks. So it is an incredibly smoothed out average. Go ahead, you were saying?
No, and that's a great interjection. And what it does is, without, like I said, and this is what we talked about earlier, if you look at the actual price chart, it's choppy and people can have different interpretations, but that's why we're always looking at first and second derivatives of these prices and price patterns. And you can see what that chart is telling us, the long-term chart. Remember, a lot of my work, or most of my work, is predicated on these 100-year, 20-year, 30-year cycles. And you can see that the longer-term trend is up. And so that red line has been a key line in the sand. And those blue circles highlight over the last 10 years when the S&P 500 has come back and challenged that level. But notice each time it's battled around that level in 2011. In 2016, it bounced off that level, and again in 2018. So right now, we've moved below it for the first time in 10 years, but we're back above it. And I think we can continue to chop around above it for the next couple of weeks or next couple of months. But ultimately, the stock market is going to tell us what is happening with the economy. It's a leading indicator. It's always looking out 6 to 9 months. And right now, the stock market is telling us that 6 to 9 months from now, the economy is going to have recovered and stabilized. But the key is, over the next couple of months, is what's going to happen to the stock market, because that's going to be a good barometer for 6 to 9 months down the road, what's going to happen to the economy.
Very nice. So you talked about how the S&P 500 has reclaimed the critical level for the last 2 weeks. A very strong technical positive. It supports the resumption, as you called it, of a long-term bull market in equities. And for those of you who don't know, a bull market is a positive upward momentum market. I believe I have a statue in the back here of a bull and a bear. The bear market is the opposite. It's a negative market. So bull and bear, if ever you're not sure. One of the neat times I got to go to New York, I got to get on that world famous bear or the world famous bull in front of the stock exchange. That was fun. That was, I don't know, 4 or 5 years ago. Super fun.